Hi everyone, I'm Bagger Don at StockMarketCaddy.com, and today is July 3rd. It's a quiet day. The equity market is not open. The futures market is open to about 1 or 1:15, and then we shut down, and we of course will be back on Friday. I wanted to share with you not just the strategy that we've been running, but also an important aspect of any strategy that you might be running. First, I hope you are running strategies. If you find your performance inconsistent, it could be because your trading is inconsistent. Strategies afford you the opportunity to begin to systemize, standardize your trading so that your performance will be consistent. Now, will it go from peak to peak to peak? No, it probably won't, but hopefully over time you get an equity curve that looks something like this. And let me just share with you, this is back here on July 2nd. This is a strategy. Let me get right on here. This is midnight. So let me bring it down so you can see. So the open profit, our open profit was 5. If you see in that bottom of the window there, I can't point to it because I got my cursor holding this open. Maybe I can't. Oops, hold on. Let me do something here that I can point to it. And bear with me. I'll come to data, data window. There we go. Okay, so this is on July 1 at just about midnight. So it's July 2nd. In this particular strategy, see if I can move this, would have been right in here, was at this point in time was $5,555. There's a lucky number, huh? Today, we're over here, and here is the profit, $7,645. So you subtract the two. That's how much this strategy has produced on primarily 2 trades. This was a buy, and this was a sell. It's a strategy that we call the bow tie. We also run something called the TPC least sensitive on this. This is a particular style of chart called Kagi. And the settings are all important. And we have some tips on getting the settings correct. This happens to be a 2.5 one tick Kagi chart. But what I wanted to show you is the performance report is certainly very nice. Here's the performance graph. It's a beautiful graph over 5 weeks. Now that doesn't mean much maybe to you because it may or may not do that over the next 5 weeks. And you know, it looks beautiful, but it made a huge run in the first 10 or so trades, and then it's, you know, kind of grinded higher. But there's no guarantee that it's going to do that in the future. But what is important is this. Let me show you. This is, I want to show it to you in a manner that hopefully makes sense. Okay, out of the total number of trades, what is the average profit per trade? And see, I can take my cursor and that'll tell me what this value is. This is total number of trades and what the average profit is. $180 per trade. That's what the model says. So you have something to benchmark. And maybe if you're up $180 on any given trade or up $400, maybe you want to think about taking that profit. But let me show you something else. This is the average winning trade. So what is that value? Do you see in that window? $652. $652. Remember that number. $652. Now, what about the average loss though, Bagger? The average loss is $197. So let's do some quick math here. Bear with me. 652 divided by, what did we say? 197? 197. Okay, 3.30. That means our profits are running 3 times larger than our average losses. That's good, right? That's good. Now, there's no certainty that it's going to do that next week. There is no certainty that it's going to do that in the next 5 weeks. But if it doesn't do it, then maybe we need to go to another market. Maybe we need to make some changes. Maybe we need to change the size of the chart a little bit. Maybe we need to make an adjustment. But at least you have some idea, some concept. Before you commit your time and your capital, you don't want to be just flipping coins. You can be fooled by that. If you follow a moving average, let's say, and that's even less than flipping coins. There's nothing magical to the moving average. And you could get a cluster of wins, 10 in a row. And then you could come right back to par, So you also want to know something else, though. What is the drawdown? What do I mean by drawdown? When you put a trade on and it goes against you, that is called a drawdown, right? You can't put your stop loss at $1. You can't just risk $1 or $5, and that stop just can't be arbitrary, or you'll get stopped out, stopped out, stopped out. You have to have a draw. You have to be able to weather a drawdown. You need to be able to let the trade breathe. So this is the average drawdown over the last 5 weeks for this particular strategy on this particular chart. What is that drawdown? $268. Okay. For a futures contract, a mini, that's palatable. I could live with that. Now, some of them are bigger than that, but the average is $268. So that's good to know. Well, on the other side of the coin, sometimes these trades run way up. Let me show you. Let me close this for a minute. We're going to come back. This trade ended here. It closed here. Well, what if you sold it up here? Well, but how would I have known to do that, Bagger? Well, let's go back to the performance report. This is what we mean by systematic trading, one of the ways. We come here to run up. What is the average run up? $800 and $900, almost 3 times the average run down. That's good to know. So that if you were in this trade and you ran up to $1,200 or $1,500, maybe you could have said, hey, I am beyond the model's average run up. Maybe I should take my money. Just on the probabilities. And the same thing on the winning trade. In fact, let's go back and see how much did this trade actually pay if you just wrote it out. So we can do that too. We can come here. This is accurate now. We can come to something called the trade list, and I can come here to the last trade. Now it's in this trade. You see, this came to, the last trade was $815. But what was the run-up? Let's see if we got the run-up in here. Here. Do you see this? Here is $815. The run-up, this is, look at the one before that, but the run-up, let's see here. I want to make sure. No, the run-up is on this trade was $1,555 right here. Do you see it? That was the run-up. And you knew, because I showed you, that the average run-up was 900 and something. So when you get up here to 1,500, man, you want to be tightening up your stop. And you might want to be tightening it up down here. I'm Bagadon at StockMarketCaddy.com. If you are interested in getting what we call systematic, and there's so much more to your trading, let's look at well, this would only be monthly. Let's see if we got a weekly. This is just monthly. So we only did it for 5 weeks, but we also want to look, when we're running a program over a period of time, how much is the program trading month in, month out? One of the big challenges, everybody says they want to get systematic. Well, maybe not everybody, but one of the big challenges for a new trader is staying with a systems approach and not falling victim to wanting to move that mouse, wanting to be smarter than the market, wanting to make the decision. I relinquish. I give in to the market. I'm the dumbest guy in the room. I'm going to let my systems tell me when to come in and when to get out. And then around the edges, I might just come in to take the profits. In any case, it's the 4th of July weekend. Have a wonderful weekend. If this resonates with you, if our videos resonate with you, and our postings, we're real people. I want you to have fun. I want you to do well. Somehow, some way you found us. Feel free to give me a call. It can be over the weekend. I keep my phone. This is what we do. And we love to help people get control over this part of their life. My phone number is 813-758-8263. My name is Don Marshall, and our website is stockmarketcaddy.com. Thank you.